A very good afternoon, good morning, welcome to FX Week Ahead, live market analysis with myself, Giles Coghlan. I will be looking ahead what's coming up this week. It's a big week, an exciting week, full of potential opportunity. So it's an important one to be prepared for. And it's also one of those weeks when it's very important to not jump the gun. You don't want to be entering in any positions prematurely because we're likely to see significant volatility this week. So this is the kind of week where you want to be really, know what you're looking for ahead, know when to react and know when to pause. So what I'm going to be doing, and just as different folks are entering, don't forget, as we talk about different instruments, exits, different trading currencies, etc. This is all from an educational perspective. So it's not a signal trading service, and obviously that's very important because I'm not here constantly to update with latest market dynamics. So all of it is looking over my shoulder as a professional analyst and trader, and you can see how I go about looking at the markets. What we're looking at this week is the US dollar. It's a big week for the US dollar and a big week for US stocks. We'll also be briefly looking at China and the latest developments there. The workshop webinar on Wednesday, don't forget that's 12:30 UK time till 1:30. It's 12:30 till around 1:30, depending on what we're doing, usually half an hour actually. What we're looking at is the US Core PCE print. Now, that's going to be absolutely crucial this week. Remember, the Fed are data dependent. Inflation data is the key focus for markets at the moment. And remember, when a market moves in relation to something, so what I mean by that is the market's been, and particularly the dollar, has been very inflation driven this year. If that starts to mitigate and fall, then that's good news, and that would likely mean we'll see some pushback against those moves. So when the problem comes through one avenue, the solution often comes through the same avenue. So if inflation creates the problem, then falling inflation helps solve it. You get the idea. So this week, what I need to do is I need to just give us the big picture. We have to be focused on the big picture so we can see what context everything is falling into. So I'm going to go over to the screens and talk through that big picture now as we look across different asset classes. Now, what you can see here is US futures markets, the DAX, Euro stocks, China's 50, FTSE 100 pushing all to the upside over the last few days. Now, what the expectations have been is that the Federal Reserve is kind of going to indicate, if not a pivot in rates, a pause in rates. Now, if you go back to the last FOMC meeting in November, the Fed indicated two seemingly contradictory things. One, they said they were going to be conscious of monetary policy lag. What they mean by that is that they were going to be conscious that when they hike interest rates, it's not felt in the economy until sort of 6 to 12 months later. So that is the Fed saying they're not going to over tighten. Remember, a number of economists have been fearing that the Fed is going to over tighten, that they're too aggressive in their approach and that they're going to shrink and hurt the US economy too much, and it's going to be a deep recession. So the Fed's not going to do that. But at the same time, in the meeting, Jerome Powell also said that interest rates would have to move higher than what the market previously been expecting. Okay, so there's kind of a twin mandate, and we've seen a number of Fed speakers that have come out. They're reaffirming that Fed's going to have to be aggressive on inflation, but they're also saying, it might be appropriate for the Fed to start pausing. So, excuse me, all of this has just led to expectation that the Fed may start pausing their interest rates. So the basic playbook is if the Fed hike aggressively, that's negative for stocks. If the Fed pause or show they're slowing down their interest rate hikes, that's positive for stocks. Oh, please excuse me, I think I've got a little sneeze. That's the big picture. Now, where the narrative is at the moment is laser focus on incoming US data, because on Wednesday and Thursday, we're going to get significant economic events out of the US, and that's going to form the next narrative for stocks. So right now, it's just hold. If you're not in a position and you're waiting, the best approach, in my opinion, is continue wait for these short-term moves. Because if you think about it, do we know if US inflation is going to peak? We don't know for sure. Do we know how aggressive the Fed will be? No, again, we don't know for sure. So, and also, most reasonable people would struggle to take a reasonable kind of guess in which direction the US economy is heading in which direction inflation is heading in. These are uncertain times, and it's certainly not clear enough, in my opinion, to start making a medium-term view on it. So my approach is I'm waiting for short-term narrative shifts, and I can take short-term trading opportunities. That's what's been working for me, and that's what I'm continuing to do until I see evidence to the contrary. Now, it's also worth mentioning China's 50. Now, China's 50, I had turned bullish on China's 50 recently when we had sort of a nice kind of head and shoulders pattern, looking for a break up towards this overhead resistance. We're looking ultimately sort of a 13,500, got that. Now, we're seeing Chinese stocks fall due to a number of significant outbreaks and protests that's happening across China. Now, this is quite significant because China is an authoritarian socialist state. So it's not like in the West where, you can have a protest every day of the week and it's just all sort of, managed. Instead, a protest in China is a significant challenge to the Chinese government. And you can see that residents in some of these big cities have been taken to the streets, including Beijing, Shanghai. These are influential cities, and Chinese citizens are very tired of perpetual COVID curbs, and it's very a huge strain for the Chinese population. And what they've been saying is that some of the potential images of the World Cup, of people moving freely across the world, has confused, some of the Chinese residents, and they're feeling a little bit disgruntled with the way China's authorities are handling the COVID outbreak. Now, this is a very nuanced picture here, because in many ways, China's initial COVID response has been lauded and praised as, limiting deaths and limiting the country's economic shrinkage. So in some ways, China has actually done well. But now the question is, are they holding on too much? They're being too tight. And the Omicron variant, when it came, it was more transmissible. So it's much harder to contain the outbreaks now. And their vaccination is not necessarily as reliable as some of the mRNA technologies with Pfizer or even the AstraZeneca vaccine. They've got their own vaccine, which is less effective, and the infrastructure for hospitals is not so well developed in China. So if they had a sudden outbreak, they'll be very vulnerable, particularly the elderly, and elderly haven't been vaccinated as they were targeted in the West. Particularly here in the UK, we vaccinated the oldest folks first and worked our way down because they were the most vulnerable, worked their way down through. So the question here for China is what's going to happen? So does President Xi really hammer them and arrest them? And is there brutal crushing of these protests? At the moment, they're kind of being accommodated. Or does President Xi kind of reverse the COVID zero policy? So we don't know what's going to happen. Long term, for me personally, I do see this as good value for China's 50. When I say long term, I mean sort of 1 to 3 year outlook. I think these are very attractive levels. They're nearly 50% from February's highs. And we are starting to see some bottoming action on the monthly chart in this support level. And I do think it does offer potential good value. Now, there are significant risks with China's outlook. And those significant risks include a stricter socialist communist regime with President Xi taking the country to a more socialist pivot. We also have slowing global demand, and there are general concerns that this COVID zero policy is going to shrink and really damage China's economic activity. So there certainly is potential for more downside. For me personally, over the long term, 1 to 3 years, I think this does offer a good value, because China is also releasing a number of significant programs to boost the economy. And COVID zero, will that policy be here as it stands this time next year? No, I don't think it will be. And so even if it is, it will certainly be expected to fall at some other point. So You know, I think it's quite interesting that this dip in China's 50 is finding buyers today. That's certainly not a worried market. It's not selling off in a strict, very hard sense. Anyway, it's a big story because that meant the market opened risk off this morning. So that was why equities have been pushing lower on that narrative. We've seen the dollar, interestingly, pushing lower. That's helped gold and copper higher, and silver, just putting off some of their recent levels now. Gold's a very interesting commodity, one that I've got a very careful eye on for Fed Powell's speech and the core PCE print. Oh yeah, oil markets continue to push lower as European nations struggle to find and agree on a Russian oil price cap. If they sort of agree to sort of $60 or lower, that should be supportive for oil. If it's more than $60, if it's sort of 70, 75, then I'm not expecting anything tradable. But the best opportunity, in my view, will come from a Russian oil price cap that's agreed in Europe about $60. I would anticipate that boosting oil prices if we got that. Yields, again, bond yields just generally tracking lower out of the US on expectations that the Fed can be less aggressive. So we've seen those moves lower now. We've seen dollar weakness on the back of that. And now what we're looking for is the next piece of the jigsaw. So the dollar's the best way to look at this. The dollar's been selling off because markets are thinking, okay, the Fed might start pausing. If we see very strong inflation data and Powell repeats to the market, no, we are hiking interest rates more aggressively, then this dollar weakness can reverse. And there's good opportunity for dollar upside, which could be easily expressed in a euro-US dollar short position. Okay. Again, dollar yen upside as well might also make sense, but I would prefer to express it with a euro-US dollar sell. I'll get to the calendar and show you what I'm looking for. That's kind of the big picture out there. Okay. A couple of things to note is platinum is in a very interesting place here. Platinum has hugely strong seasonals coming up too. And buying platinum could be very attractive if we get reasons for dollar weakness. At market, stops sub 958 make a lot of sense. You could potentially look for a move up to 11 or even maybe 1140, 1150. So there's very, very nice potential upside there in platinum that's worth recognizing. Okay, folks. Yeah, that's the China COVID zero plan. Just some reasons on the blog. Do check out my blog. I go into some detail about why China's holding on to its COVID zero plan, what the appeal is, and why it can't just dump it. It can't just say we're quitting. It has to be a slow removal. That's what I said, you know, all the way back in, was it in May of this year? It says the logic behind China's moves, it shows it will be very hard for China to have a sudden reversal of policy. The implications are that it will be more likely to be a slow burn in reversing, exiting the COVID zero policy, what you've seen, than a quick pivot. So China's 50 index may keep moving sideways for some more time. So even back in May, seeing sort of more sideways movements, and we actually have had more downside. But eventually I'm expecting China's 50 index to turn around. Again, always define and manage risk. It's not trading advice. It's just my personal perspective on that. There are different alternative views, obviously, and it depends a lot on how China's economic activity develops from here. Let's look at the economic data. This is going to be crucial for this week. Very, very interesting as well. Good opportunities potential that I can see. Okay, so what we're looking for here on Monday is got Fed's Williams speaking. So this will start setting the mood music, and we could see a push. And one way or the other, if Williams starts talking, you know, very strongly about the Fed pausing, that can allow some of that dollar weakness to come back, and we'll go upside to gold, upside to stocks. If he's more if Williams is more hawkish and really starts pressurizing, you know, the Fed has to keep hiking interest rates, you know, the higher interest rates, and that's likely to push gold lower and push stocks lower. Also look at the risk tone and what happens with China and how China President Xi responds to these uprisings. If he's aggressive and vicious and really pushing it back against it, then that's likely to strengthen the dollar, weaken stocks. If he's very accommodating, says, I can understand people's frustration, we're looking at, you know, removing COVID zero piece by piece, or anything like, you know, in that tone, he's not going to say it that way, but anything that leads to that kind of conclusion, then that will be upside for gold, upside for stocks. Tuesday, again, very, very quiet day. We've got some Bank of England speakers, but I'm not looking at anything for the pound because the dollar's just going to be so focused on what's happening with the Fed. We've got some consumer confidence data, which could move markets a little bit. What we would want to see there is, very high consumer confidence would allow some of that dollar weakness to fade. So if we got consumer confidence coming in, above 104, I'd expect a little bit of upside in the dollar. And so I'd see, short-term euro-US dollar potential sell opportunity I'd look for. Would I personally look for it? Probably not. I'm going to wait until Wednesday because for me, when the Wednesday data is the key. We've got an RBA speech, but again, Australian dollar wouldn't want to get involved in any moves, particularly in the Aussie-US dollar, ahead of the core PCE print. Eurozone CPI, again, is there going to be the market's focus on this? No. If we see very high inflation, that's what the market's already expecting. It's expected to be, roughly equivalent to the previous 10.6, 10.4. The only good news for the Eurozone would be if it was a massive miss, but it's very unlikely to be. And, anywhere within that range, even outside of that range, is it going to change the ECB's perspective? Very unlikely. Is it tradable? No. In my book, it's not one that's worth focusing on, even though, usually that would be a good data point. In the current market context, I'm not interested. But what I am interested in is Fed Powell's speech on Wednesday. This will be tradable, in my opinion. So what I'll be looking for here is any indication from Jerome Powell about what he's expecting in terms of the pace of Fed interest rates. Now, if you just take a look here, let's just move this week. There we go. You can see at the moment, the Fed's kind of pricing is that the Fed will hike by 50 basis points at the next meeting. And it's a 63-36% chance seen by short-term interest rate marks. Now, if Jerome Powell starts being really hawkish, if he starts sort of really laying it on the line that the Fed has to keep hiking interest rates, that maybe he's worried about the recent rise in stocks, if he says that the stock market is prematurely pricing in a Fed pivot or something like that, and that the Fed is going to continue to be aggressive in hiking interest rates. If he really pushes that, then what we'd be looking for is some dollar strength. Okay, so this dollar weakness that we've been seeing recently would reverse, and that would send the euro-US dollar lower. So on top of that, we'd also expect some of this recent upside in stocks to reverse, and I'd expect stocks to move lower as well. And we'd expect stocks to move lower on a hawkish power, and I'd expect gold to move lower as well. Okay, so a big move down in gold back to that key support level would be highly likely if we saw the situation where Fed Powell was more aggressive. But I only see, this is the crucial bit, I only see a short-term opportunity because the Fed is also data dependent. And what's the key focus? Of course, it is inflation. So if we just take a look at inflation data, right? So here's the core PCE year-on-year data. Let me just pull that across. So what you see is that the core data has been rising, 4.7, 4.9, 5.1. So if we go to the core PCE data expected for Thursday, what you'll see is you'll see that 5% is expected. So it's expected to pull back a little bit. Now, the price index data has already been showing some signs of kind of flatlining, stroke pulling back from that 7% peak. So the price index, you can see that the prior was 6.2 and expected to be 5.9. So in other words, markets are expecting inflation to show some signs of peaking. Now, if Powell is hawkish, and then this inflation print is high, when I say high, if it comes in above 5.1% and above 6.2% for the year-on-year price index and the core and the year-on-year price index headline, if that comes in high, then we would expect significant dollar strength. Now, I would express that either gold shorts, S&P 500 shorts, or Euro US dollar shorts. All of that would make sense on the dollar strength. So what you're looking for is one, I'm looking for Powell. If Powell is hawkish, then I expect downside in stocks, downside in gold, downside in Euro US dollar. But then I would be looking to take profit very quickly. So maybe within 1 hour, 1.5 hours, move up to the latest pivot point, take profit, get flat, and then wait for the PCE print on Thursday. Now that would be very interesting, okay? If we see a big miss in the data, then that would be saying, well, Powell doesn't need to be so hawkish, and you can see a reversal of that move. So what we're likely to see is significant volatility this week. So that lots of choppy, you know, we're expecting to see price action like this, like chopping up and down. So what you want to do in markets like these is just move with whatever the latest shift is. So that's the big US dollar story. And of course, it closes out with a non-farm payroll on Friday. So then you can get a third opportunity with the non-farm payroll. If there's a big miss in jobs, it will mean the Fed needs to be less aggressive, and that will be upside in the S&P 500, upside in Euro US dollar, upside in gold. And that would be if the headline comes in below 150,000, unemployment rate comes in above 3.8%, and if we see the average hourly earnings coming in below 4.6, all of that would be bullish stocks, bullish gold, and bullish Euro US dollar. So you got 1, 2, 3, and then even after that, you got Fed speakers at the end. So this is a week where you want to be nimble, taking short-term opportunities. On Wednesday, we just have some Swiss inflation data. Not expecting much out of that, but just check in case there's a surprise. Big miss to the downside would allow some of that Swiss recent strength to mitigate. So, you know, if we did see a big miss there, not something I'm really looking at trading, but just worth noting, just checking there isn't a big surprise in the Swiss inflation data. But otherwise, that is the main issues. It's a US dollar focus week. And the best scenario is to be absolutely focused on that US dollar story. And that's it. So I will be here on Wednesday, and I'll go through exactly how I'm personally looking at trading the core PCE print. Okay, let me just check the time. There's no conflict. Sorry, let me just check the time. Core PCE 1:30. Yeah, that's absolutely fine. I do the webinar at 12:30, so just perfectly in time. And I also trade these live events myself for my subscribers, so I'll be doing that as well live. But I'll be getting us ready, HYCM clients, beforehand, so you know exactly what I'm looking for. Okay, folks, just check there isn't any questions. Otherwise, okay, it's good to see you. Thank you all for coming. Gavin, Guy, good to have you. Ignatius, Johan, as always. Kingsley, good to have you. Max, Mihai, Suneth, good to see some familiar faces. Okay, folks, I think that's all clear. Everyone seems okay. Doesn't seem to be any problems there. It's all just check. Last chance. If there's anything you weren't clear on, want me to go over again, do. But I think we've got the big picture here, and that's what I'm looking at. Or, as always, manage and define risk in case markets don't behave the way we're expecting. But that's what I'm expecting for this week. Yeah, that's great. Yeah, thanks, Max. See you Wednesday. That's super. Take care, everyone. Now, goodbye.